Hey, it's Richard with Matthews Wealth Management. I'm here in Charleston. We've had a family health emergency. Don't think that I'm just sitting back enjoying my time at the beach. We're going to change up the market updates a little bit from last year. Specifically, I think I lost a lot of people in the numbers. So I'm going to start with the key topics and just kind of go through that. We'll follow up with the numbers at the end if you want to see that. It kind of proves what I'm about to say, if you will. But I think this will be a little bit more entertaining and engaging for people. So January was crazy. January 2022 specifically, we had a lot of resets, a lot of losses in the markets, which you'll see in the next section. But specifically, unemployment, supply chain, inflation, it all kind of comes down to regulatory and monetary policy. That's where everything is controlled, and that's what we've been saying for 2 years now. If you go back and watch all the videos, you'll see it. But currently, we're looking at unemployment at 3.9%, and I know that's been celebrated in a lot of areas, and traditionally, that's a great number. We kind of question, what does that number mean specifically? It seems to be a moving target, and that's what we saw all of last year, was changing the definitions of everything in the markets, everything in the economy, and how we measure things. And statistics can make anything come out of statistics that you want. But I've heard recently that COVID is a concern for why our unemployment might be so variable, if you will, that people are out sick and therefore they're not employed, or maybe we're having productivity issues because of so many people out sick. And I think one of the big issues is people are out. Defining sick might be a different thing to dive down into, but these people are coming back. So the same amount of people that are getting sick and coming back from work, there'll be ups and downs as we go through cold and flu seasons, being inside and so forth. There's a lot of respiratory illness trends that we can look to kind of equate COVID with a different correlation if we need to. But yeah, I'm not sure that really holds water. Traditionally, a 3.9 is awesome. So we're still way behind on our supply chain and so forth, which we'll dive into. But currently, 4.6 million more jobs are available for people to come in than people unemployed. So again, it points right back to defining what is unemployed. And it has to do with the participation rate of people seeking employment. And that seems to be very low. So there are obviously reasons for that. But one of the biggest reasons is that the average worker is looking at labor earnings growth, right? If I were working, let's say, a $20 an hour job before the shutdown and lockdowns from COVID and everything, maybe it's going to take me a little bit more to come back, especially if I have some unemployment that's still trickling in, or if I made a ton of money in Bitcoin while I was putting back my stimulus money. I might have a little bit of a reserve to live on while looking for the right job that's going to let me stay at home, that's going to pay me what I want, what I deserve, and depending on what I'm looking for. A lot of people have left hospitality, hotels and cruise lines, et cetera. It makes a lot of sense why they would. So people are shifting kind of industries as well. So that leaves a little bit of time frame for people to get back engaged in the labor force. But earnings growth, it takes more to hire somebody, obviously, in this day and age, and that kind of pairs into inflation, which is where we get into the balance, if you will. Inflation's not necessarily a bad thing. I think in 95% of cases it is a bad thing. Inflation makes sense to offset for population growth. It also needs to be weighed against GDP and productivity and what we're actually producing with our labor costs. And therefore, worker income, especially for our standard of living here in the United States, needs to pace our inflation rate, right? And so everybody's saying it's not a living wage, right? Or you can't work full time and provide for your family doing X, Y, and Z. And really what we're talking about is what is the income amount and what can that income buy us, right? So if beef and bacon and gasoline and all that stuff is going up faster than our income is going up, then we're actually losing our standard of living, right? And that's what everybody's ultimately concerned about, is making sure that we live better and better each generation. And that comes from technology increases, it comes from scalability, it comes from finding better ways to do things, not having to drive to go get food, having Grubhub or DoorDash or somebody coming to bring you stuff, it changes everything. So that's where supply chain comes in. I think there's a big misunderstanding when people say supply chain. Econ 101 talks about the supply and demand curves. What people don't think about is that stuff shifts, right? Demand shifts, supply shifts. And one of the biggest things we saw during the lockdowns was that our supply chain, which is just a nice little sales term there, but our supply structure, if you will, has shifted permanently, I believe. So we didn't really have a drop-off of demand during COVID. A few people put back and saved extra income that came in, like from the child tax credits, et cetera, or the stimulus checks. But ultimately, our demand increased, and it increased through Amazon and delivery. And so the way that we get our goods and services has shifted permanently because we were all sitting at home, right? So when we say supply chain, it's not that we stopped going to work, therefore stopped producing, because the United States doesn't really produce anything. We import everything. So when we say supply chain, and we're looking off the ports of Los Angeles, for example, to see all the ships that are out there, or Charleston, might even see one behind me here, these ships are backlogged, not because we just rebooted and started the global economy again, but because that's pretty much how we're getting all of our goods and services. So our demand has increased, and now our supply is trying to keep up with that. So then the next thing is, how did demand increase as everybody stopped working? And that's coming a lot from how we decided to print money, right? And that's why we're concerned about the consumer inflation, right? All the costs that are going up, and then we're comparing that to our income and our labor earnings, right? And making sure that that grows. And a great example would be looking at Social Security. Most of the time, people would celebrate, and there'd be parades down the street for 5.9% cost of living adjustments for Social Security. We're used to 1.2, 1.8, 2.1, small stuff. And then this year, we did a huge bump, 5.9%, but our actual inflation rate was more like 18%. So nobody's really excited about their 5.9, and I think that's more of a deep down psychological piece to all of this that we all know. We all live day to day. We see the prices. Those of us that keep a budget, those of us that do the grocery shopping or stop to get gas, like it's just there, right? We see what's happening here. One of the big concerns or talking points of supply chain is that we're still under threat of COVID, whether it's the actual disease or the infection of the virus, or whether it's about potentially locking down, or vaccine mandates and losing workforce, or fines, right? Like it's the reaction to the virus, I think, that has everybody concerned, right? So regulatory things, when we're talking about things like Federal Reserve policy or tax policy, or how we're going to support the new supply structure to get our goods and services, Omicron's the same thing. It's a reaction or a regulatory stance that has the influence over our concerns here, right, with inflation. So the truckers up in Canada, it's a great example of supply chain and how we react to a virus, right, that really is shifting the narrative of how these financials play out. Lastly, one of the biggest reasons for the crash of January had to do with the threat of rate hikes. And I'll do an additional video to back this up, but like in the next segment or whatever. But for 12 years, we should have been hiking rates. We should have gone back to normal interest rates, like when a CD would pay you 4%. Bonds would pay you 3.5%. You could get a municipal bond at 5.5%. Corporates were 6 to 7%. And when we're looking at interest, we're looking at the value of time. By offsetting that with growth goals and investment goals to create the next technology leap or whatever, you have a fair comparison. You have a competitive market of, I can be safe and get interest, or I can be risky and maybe get more return, right? There was this little battle. Now there hasn't been for 12 years, and the threat of rate hikes has people on edge. I don't know how we didn't see it coming, but I think the inflation numbers, it's not transitory, never was going to be transitory, just because of the underlying economic and financial piece here. I've been screaming from the rooftops, it's not transitory, but the potential of rate hikes, whether it's going to be 3, 4, 5, 7 is what Bank of America just said. So those rate hikes have everybody on edge. And so that creates a huge sell-off in equities, especially the growth side, which we'll get to in the numbers in a second. But bonds are very sensitive to rate hikes. It's called interest rate risk. And I haven't done a video because I have a very creative way and I haven't had time to do it. But interest rate risk basically says that if rates double, the value of your bond gets cut in half, right? So current rate, federal funds rate is 8 basis points. Doesn't take much for us to take a huge loss in bonds. So that's what we saw in January, was that stocks dropped, bonds dropped. And everybody's used to this negative opposite seesaw correlation. That doesn't exist since we've artificially lowered interest rates from a reasonable time value of money. That's basically what we're doing here. So that's got to go up. Let's say 5 to 7, or 4 to 7 is probably more fair. How many rate hikes we'll have. Bond purchases, we call this quantitative easing, right? The Federal Reserve has been purchasing $700 billion per month from the Treasury. So a lot of these types of bonds, this is actually part of where mortgages are coming from. And the big mortgage, Fannie Mae, Freddie Mac, it's all backed by all this stuff that the Fed's buying. So they've been purchasing 60% of Treasury issuances, and they're going to stop doing that. So as they've built this up over time, especially over the last year or so, I'll do some metrics here in the next segment, $700 billion per month, their entire balance sheet has grown to $4,717,651 million. And so there's going to have to be a liquidation. So if they were the ones buying the treasuries at a low interest rates are going up, the value of these treasuries drops, and therefore they're going to have to sell this. So is the market going to want to buy the old 1% interest bonds? No. So this is going to tank. It's a concern of what happens to the overall bond market when it gets flooded with this extra supply. There's not enough demand to support that kind of supply of treasury bonds because the interest rate is garbage. So lots of risk that has been built into the system over the years, especially the last, I'd say January 20. That's kind of my metric. So we look from current January 2022 to January 2020, and that gives us kind of the COVID cost. And then we go back pre-COVID all the way down to 2010, once we started doing a lot of spending and a lot of building on the balance sheet and a lot of quantitative easing and a lot of low interest, 0% interest. So looking at that decade, looking at the last 2 years, that's kind of how I'm showing the trends here, and we'll get into that in the next section. So hopefully it's cool to put all these at the front of these videos going forward. It's cool to have a background that's so pretty, but I hope we don't have it next month. So anyway, on to the next segment. Okay, so lights going down. The lights have been crazy. Like, this is incredibly hard to do, the lighting with such a bright background, but this is pretty much the only whiteboard I have down here, so bear with me. Getting to the last segment is going to be really tough to get done in time, but to continue from the last section, I wanted to cover M2SL, which is total money supply that's been created over time, and then the Fed's balance sheet, just specifically. So we'll go from current 2021, 2020, and then the previous decade to 2010. So M2SL, we're at 21,638,100,000,000, which is just a ton of dollars. Now, if we were putting that with population or GDP growth or something like that, that would be reasonable. That would make sense for purchasing power to kind of be the same for how we live our lives, but this is way too much compared to what we've seen. So since last January, we're up 11.69%. So don't think of that as just pure inflation that hits the road. There's actually a timeline of early inflation, consumer inflation, asset inflation, and I'll do a separate video while I'm down here that's going to cover kind of where money moves and how that affects what we feel as far as pricing. And so asset prices in the stock market or the bond market or commodities, commodities can kind of flow into expenses, obviously for lumber, if anybody remembers that last year. But anyway, don't immediately think that 11.7 comes out and hits the ground running as inflation. It can take some time. However, coming from the beginning of COVID, we're up 40.44% in terms of money supply, and definitely we're feeling that. The price of used cars up 35%, probably 38 now. I haven't checked since December, but yeah, so there's a lot of inflation that does start to line up with this big number. We've slowed down the printing press a little bit towards the end of last year and then in January as well. But if you look at the cumulative numbers, this is big. And then I went back, so this is a 2-year number, 40%. And I said, all right, well, what was the previous decade? And keep in mind that this M2 money supply during the years of Obamacare was huge, right? Like when we had bailouts that happened, from the Bush era, and then you had Obamacare, you had the bailouts after AIG, and yeah, just all sorts of fun spending. That was only an 82% increase, and I say only. That's crazy. We haven't had an 82% increase in population or productivity in GDP, but 82% through these years, and just in the last two, another 40%. So that's a tremendous amount of raw dollars being pumped in. I wouldn't even say that that's 5 times as much as what we're seeing, but in the previous decade. But those numbers are staggering. I mean, that's crazy. This is actually kind of a little bit in comparison to what we've just done since the COVID shutdown. So obviously we're going to feel this. If we wanted to have the standard of living we had back in January of 2010, it's a long way away, unless we can get some big GDP growth, which it doesn't look like we will. Balance sheet on the Fed, currently we're 8.9 trillion. I'll just shortcut that. So 8.9 trillion on the balance sheet. That is a lot of money that the Fed is sitting on, and that's bonds and cash, right? So they've been buying treasuries from the U.S. Treasury. They've been also buying them on the secondary market. They've been buying a lot of corporate junk bonds on the secondary market. So this balance sheet is filled up with a lot of securities and things that need to be put back out there and sold as asset, and which obviously is either going to create inflation or it's going to tank the prices. Neither is good, and it's really the same thing. But yeah, so we were up 112%. I shouldn't say we, because the Fed's private, right? So they are up 112% on their balance sheet, which is just stuff that they've bought and accumulated, and they're trying to hold on to it as a way to minimize the inflation, right? So we had this inflation just from money supply that was created, but we have this that hasn't hit the economy yet. This hasn't been released out into the world to create more consumer inflation. So even though we did roughly 6 trillion of just printing, we still have 9 trillion that's sitting on the Fed's balance sheet. Now they had in 2010 2.2 trillion, so it's unlikely that they'll unwind all of it. But since this affects our economy, I still don't know how they're private and unaudited. So that's my quick little soapbox. It's crazy. So we're up 112 in just the 2 years. From January 10, we're only up 84. So 84, 82, that kind of lines up. 40 and 112, a lot of it's been going on behind the scenes. And a lot of this money that's been funneling from the Treasury to the Fed, since they were the primary buyer, they're also buying it through banks. So banks are getting a premium on issuance. There's a lot happening behind the scenes that's not talked about on Bloomberg or CNBC or any of these big programming things. So anyway, let me try to get the asset classes up there for the very end as the numbers. So hopefully we'll be able to see, but if not, I might have lost a bunch of you by now. Okay, so we got a different format. This is something I was thinking about as well. The long list of 1 month, 3 month, year to date kind of takes too long. It's a little bit difficult to follow as well when I say all the values, all the growths, all the blends or whatever are doing certain things. This is the format that we use in all of our discussions with client meetings. If you go check my modern portfolio theory or asset allocation videos, you'll also see this box. It's basically 9 asset classes of U.S. equities is what we're tracking here. So the box, I think, visually gives a better clue as to what's going on. It also kind of reinforces what I'm saying in these client meetings when we go through Morningstar snapshots or many other reports. This is kind of what we're looking at. So what we've got is large caps. Those are the big companies, mid-sized companies, small companies, value, core, and growth. So I think this is the great example of back when we moved out of growth. I kept saying growth to value rotation. I don't even know if we've got the full rotation here, but definitely we had a huge sell-off in growth stocks. So We were down 13 in large, 14.5 on mid as well as small. We were positive in large value, mid value, which we overweighted back in September. Maybe a little early, but it's better early than late, as you can see here. Big growth sell-off, and I think in the last, well, today, I've been keeping up with the market down here. You can see a little bit of a rebound, at least in the NASDAQ. Some of these tech stocks earnings came out. Haven't seen Alphabet came out just recently with their dividend and after hours. Anyway, on a little side talk there. So growths are a big sell-off, right? And that's the concern, is they have usually the biggest PE, and so more leverage, and they need to continue their growth. And if we see earnings are a little bit off, or if we're anticipating rate hikes, or liquidity is going to get a little bit more difficult, they can't do more stock buybacks. People are redeeming their shares because either there's fear or they need the money now, or whatever the purpose is. These are the quick ones to drop off. I'm kind of surprised that we maintained some positives in January for the value, at least before you get to small. Small might be fear of liquidity drying up for the smaller companies to be able to keep borrowing and growing. But anyway, huge sell-off in the world of equities. If we go over into bonds, actually, let me jump to international. International sold off about 5%. Emerging markets has been pretty resilient. That's kind of cool. I don't think that they're doing the money printing game that like the rest of the world, developed world like international would show. But in bonds, short terms are down roughly 0.75%. Intermediates 1.5%. We got out of the way of this big long term. Again, this is back to interest rate risk. So if rates are going to go up, the long-term bonds take the biggest swings, right? They're on the far end of the yield curve, so they swing the most, down 5%. So if you were in, let's say, large cap growth and long-term bonds and some international, just everything's down, down, down. It's a really rough portfolio. High yield is down 2.73. It's interesting that long-term bonds from the government lost more than junk bonds from corporates, but that's just kind of the world that we're in with interest rate risk. Tips are down 2.02%, a little bit concerning since we went heavy into tips. We went heavy into tips in short-term bonds. Short-term made sense. Tips, it'll be kind of weird to see how this works. They did really well 2 years ago, actually tracking the inflation that we were seeing. Whether or not they change how they look at the metrics, who knows? We'll see how this works on new issuance of tips. Real estate started its correction. I've been calling for some sort of a correction once the foreclosures and evictions started on leasing and mortgages that weren't being paid. They were up 30% last year, so we haven't really scratched the surface yet for me to say, hey, I was right. But that's a correction, not quite as much as the growth. Oil up 18%. Consumable commodities we put a very large amount, not large enough, but a fairly large amount into consumable commodities. Nickel has also taken off for the electric vehicle craze. Gold down 1.88. That's not a consumable commodity. That's pretty much a fear place, I suppose. I mean, you would think that with bonds selling off and gold and growth selling off, that when people get fearful, they would go buy gold. It has not happened yet. Maybe they buy oil now. Maybe it's changed because we see what's ahead for us. S&P's down 5.17 in the month of January. A moderate portfolio, 50-50 stocks bonds, would be 3.86. So it took a little bit less loss than what a general S&P moderate aggressive type risk would be getting or losing in this case. But yeah, 3 asset classes positive, everything else majorly off, even in the world of bonds. So we'll see what happens through the month of February. I hope I don't do another one here. The lighting is terrible. Our family health emergency is also terrible. So hopefully that comes to an end here pretty soon. But yeah, I think I've got another video I'm going to do while I'm down here. If I can get the lighting right. I like having a board to write on, but we'll see how it goes. So if you've got questions, feel free to email. I am still working. I enjoy distractions instead of sitting here twiddling my thumbs staring at financial stuff on the computer and the TV. So reach out, talk, catch up. Hope y'all are doing good, and look forward to getting back and seeing y'all soon. Take care.